In August 2019, this company was worth $47 billion. By October, it was worth less than 8. No fraud, no crime, no market crash, $40 billion simply evaporated in about 6 weeks. And the only thing that changed was that, for the first time, outsiders were allowed to read the paperwork. Some of that $40 billion belonged to the people who worked there. They are not the ones who walked away rich. Hold on to that. We'll come back to it. This is the story of how a company convinced the smartest money in the world that an office rental business was a technology miracle, and how one boring, legally required document called the bluff. This is the Rubicon Brief. We go inside the biggest deals in business, the structure, the strategy, the decisive moments. Today, WeWork, a company that set out to elevate the world's consciousness and succeeded mainly in depreciating its shareholders' capital. Most people believe the failed IPO killed WeWork. It didn't. The IPO wasn't the disease, it was the diagnosis. WeWork was never the technology company it was priced as. It was an ordinary real estate company wearing a technology valuation like a borrowed suit. And the whole story is the distance between that $47 billion number and the truth. WeWork sold itself as technology, a platform, a network, software that happened to have chairs in it. There's a simple way to test that claim. One some very smart people skipped. Find another company doing the same thing and see what the market pays for it. This is IWG. You may know it as Regis. It rents office space by the desk in buildings it doesn't own, which is to say it is WeWork without the free beer and yoga mats. In the first half of 2019, the two made almost the same revenue, around $1.5 billion each. The same business at the same scale. The market valued IWG at about $3.5 billion, a little over 2 times its sales. WeWork was valued at $47 billion, around 15 times the same kind of sales. Same business, same revenue, roughly 7 times the price. It gets stranger with profit. IWG made some. WeWork on the standard measure of operating earnings made none. Its number was negative. You normally value a business like this on a multiple of those earnings. Do the arithmetic for WeWork and the multiple comes out negative? Finance's way of telling you the question doesn't apply. So, if the business was, on every available measure, an ordinary property company worth a few billion, where did the other 40-odd billion come from? Not from a spreadsheet, from a story, and one man who told it better than anyone alive. Adam Neumann co-founded WeWork in 2010. By every account, an extraordinary salesman, magnetic, relentless, and entirely unburdened by the gap between what he said and what was true. His prospectus would use the word technology more than 100 times for a company whose actual business was signing office leases and renting the desks out by the month. The consciousness raising on inspection was a sublease. His real talent was for raising money, and the clearest example took about 12 minutes. In December 2016, Masayoshi Son, founder of the Japanese investment giant SoftBank, visited WeWork with 2 hours scheduled. He gave Neumann about 12 minutes, asked him to finish in the car, and by the end of the drive had sketched an investment on his iPad, telling Neumann the company wasn't crazy enough, that he should think 10 times bigger. The check was $4.4 billion, a 12-minute meeting, $4.4 billion. It is the most efficient piece of salesmanship in modern venture capital, and the clearest sign that almost nobody was checking the work. Neumann also made sure nobody could. He held shares with around 20 votes each, so the company answered to him alone. And, in the detail that tells you everything, he trademarked the word "we" through an entity he controlled, then sold it to his own company for $5.9 million. Nearly $6 million for the word "we." it was later quietly reversed, which tells you that someone eventually did read the fine print. By then, almost no one with money on the table wanted to. Here is how the number grew. Each round was priced off the last, not off profits, there weren't any, but off whatever the previous investor had agreed to pay. So, it climbed on its own momentum, doubling and doubling again, until SoftBank's January 2019 cheque set the headline at $47 billion. None of it had ever touched a public market or public scrutiny. You might assume the professionals caught what was happening. Some did, but not nearly enough of them. At the end of 2018, regulated mutual funds, the firms that look after ordinary people's pensions, were carrying WeWork on their books at wildly different numbers. Fidelity, around $28 billion. T. Rowe Price, around $25. A group including Hartford and John Hancock, around $42. The same company, the same financials, valued $17 billion apart. That gap is the tell. Some genuinely believed. Others simply assumed they'd be out before the music stopped, that there'd always be a larger fool to sell to. Either way, none of them was pricing the business. They were pricing the story and passing it on. The story held for 9 years, because no one outside the room was forced to test it. Then WeWork went to go public, and that means by law, opening the books. On the 14th of August, 2019, it filed its S1, the registration document every company must publish before selling shares. For the first time, WeWork stood in front of people who were not in the room, not on the payroll, and not under its spell. They read it more carefully than SoftBank had. The numbers were extraordinary. Revenue of $1.8 billion in 2018 and a loss of $1.9 billion. It was losing roughly $2 for every dollar it took in. And the detail that should have ended the argument years earlier. WeWork had committed to $47 billion in future rent, on leases running 15 years and more, against about $4 billion of revenue its members had committed to, most of whom could leave at a month's notice. $47 billion contracted to go out. $4 billion, maybe, coming in. The S1 didn't reveal a fraud. It revealed a business model, and written down in black and white, the model was plainly impossible. Within weeks, the valuation fell from $47 billion toward 10. Not because the company had changed, but because at last, people were reading. The document didn't break WeWork. It was just the tide going out and showing who'd been swimming naked. What followed was a controlled demolition, and a fast one. The IPO was pulled on the 17th of September. Neumann resigned on the 24th, and in late October, SoftBank, already in for the better part of $10 billion, had to mount a rescue just to stop its investment reaching zero. That rescue valued WeWork at under $8 billion, down more than 80% in about 6 weeks. SoftBank's founder later called the whole thing a stain on my life. By the time WeWork went bankrupt 4 years on, that stain had cost him around $14 billion. The smart money, it turned out, was just money, moving in a herd. SoftBank could afford it. $14 billion is a stain, not a wound. But every story like this has people further down, the ones who can't afford it and never get asked. At WeWork, that was the staff. In the same weeks the bailout was being negotiated, WeWork laid off around 2,400 people, about a fifth of its workforce. Many had joined early and taken lower salaries than they could have earned elsewhere, making up the difference in stock options. They were betting on the company. When the valuation collapsed, those options were worth nothing. They had taken less in good faith to build something they were told would make them whole. It didn't. Some wrote to the company afterwards. The word they used was graft. Because while their stock turned to paper, the man at the top was negotiating his exit. Adam Neumann left with a reported package worth around $1.7 billion, on top of the more than $700 million he'd already taken off the table. Unlike the staff, with their worthless options, Neumann had been selling his shares for real money at nearly every round since 2014. Everyone lost. The funds, the staff, SoftBank, 14 billion of it. Everyone, except the man who built the fiction. At this point, you might reasonably expect the part where someone goes to prison. There isn't one. Neumann was never charged with fraud. No regulator found a crime. Nothing here was illegal. He told an ambitious story. Willing investors chose to believe it, or to bet someone else would, and private markets let that belief compound, unchecked, into $47 billion, because until the very end nobody was required to prove the number was real. That is the actual scandal. Not that a man broke the rules, but that he didn't have to. The system never needed anyone to be right. It only needed the next buyer to believe. And when belief was finally tested against arithmetic won. The company, once worth $47 billion, was, in bankruptcy, valued at around $45 million. Which brings us to now. In 2022, Adam Neumann started a new company, Flow. It does residential property. Apartments with a sense of community, powered, he says, by technology. If that sounds familiar, it should. Andreessen Horowitz backed it with $350 million, the largest single check in the firm's history, before it had really launched. And by 2025, it was reportedly worth around $2.5 billion. He has also bid to buy WeWork back out of bankruptcy. $47 billion to almost nothing in 6 weeks, with no crime committed. The document meant to sell the company is the one that exposed it, not by revealing a fraud, but by revealing the truth. Nothing changed inside WeWork. The buildings were the same. The leases were the same. The losses were the same. The only thing that changed was that everyone finally got to read the same document. And the lesson the market seems to have taken is the quietest and the worst of all of them. A well-told story can always find a new buyer. This was the Rubicon Brief. If you want more of the biggest deals in business taken apart like this one, the structure, the strategy, the decisive moments, subscribe and leave a like to help others find it. Until next time.